Ladies and gentlemen, it's my pleasure to introduce the moderator for the next panel on public equities. Apart from being a good friend, Davey Gunn is a veteran of the securities industry in Canada, having held a number of senior positions over the past 30 years, most recently as past president and CEO of Hahn Investment Stewards. Davey.
Thank you, Ian, and good afternoon, and welcome to the Long Equities panel. The investment managers on our panel today are all accomplished value investors, but as you will see, how each of them execute their value strategy differs quite substantially. The format of this session will be a 15-minute presentation by each panelist on a topic relating to how they execute their particular style of value investing. At the conclusion of the final presentation, we will invite your questions. Before getting started, I'd like to tell you a little bit about our panelists and their topics for today. Jeff Jacobowitz is the founder, managing member, and portfolio manager of Simcoe Capital Management, a New York City-based investment management firm formed in 2003 to invest in undervalued, publicly traded equities. Jeff began his career as an accountant with Deloitte & Touche and subsequently held research positions with Robotti & Company and Naples, Florida-based private capital management. Today, Jeff will discuss why he believes investors should employ a private equity approach to investing in public markets. Jeff will delve into the characteristics of the companies he looks for, and to bridge the gap between theory and practice, we'll speak about one of his fund's largest holdings. Guy Gottfried is the founder and manager of Rational Investment Group, a value-oriented investment fund. Rational employs a risk-averse, research-intensive value methodology to uncover securities exhibiting material upside potential, along with minimal risk of capital impairment. Prior to launching Rational, Guy was an analyst with Fairholme Capital Management. Guy's presentation today focuses on investor psychology and market inefficiencies. Some investors can be their own worst enemy, and Guy will speak about why even savvy investors often lower their standards when investing in the public markets. Guy will lay out a common sense approach to looking at investments with an emphasis on avoiding mental mistakes and exploiting the irrationalities of others. And finally, Frank Martin, founder of Martin Capital Management, has written prolifically about the capital markets and economy since 1971. His published works include numerous essays, commentaries, annual reports, and 2 books, Speculative Contagion, published in 2006, and A Decade of Delusions, published in 2011. The foreword for Decade was written by Vanguard's John Bogle and received blurbs from Warren Buffett, Seth Klarman, Bob Goldfarb, James Grant, James Montier, and Edward Chancellor, among others. Frank goes about investing a bit differently. He combines a macro overlay with bottom-up fundamental research. His presentation today is titled, How Not to Be a Thanksgiving Turkey, a reference to the unsuspecting bird that gets fattened up all year only to lose its head and become someone else's main course because it didn't know any better. Being a Thanksgiving turkey investor, Frank says, feels good until it feels really bad. And now to start things off, I would like to invite Jeff to start his presentation.
Thank you, Ian and Mo, and the Prime Quadrant team for inviting me to speak. I'm pleased to be here in support of Mount Sinai Hospital, and I'm especially grateful to Mount Sinai because my wife was actually born here. My name is Jeff Jacobowitz. I founded and manage Simcoe Capital Management and Simcoe Partners. We invest in public companies, mostly small cap, US-based, and we're a concentrated portfolio with typically no more than 10 to 15 core positions. Today I'm going to talk about a style of investing that I think is very, very compelling and that I don't hear much about. What I like to call private equity type investing in public companies. What I mean by that is investing in public companies that A, would typically be attractive to private equity firms, and I'll get into what kind of companies those are, and B, public companies that behave and are managed as if they were owned by private equity firms. Why private equity type investing? First and foremost, I've done it and it works. Second, it's a very common sense businessman's approach to investing. Probably the way most of you here would look at a business. How much capital needs to be invested, how much free cash flow is being generated. That's very appealing to me as I happen to come from a family of business people. In our portfolio, we've had 25 takeovers in the past 10 years, mostly from private equity firms. I've also been on the board of 2 NASDAQ companies, both of which were sold to private equity firms. What I've learned is that if you invest in public companies that behave like they're private equity owned, then one day they probably will be private equity owned, and that usually means a very nice premium. So what type of companies are attractive to private equity firms? It's important to understand what private equity firms do. When they buy companies, they typically place significant amounts of leverage on the companies they buy. That, of course, means very significant annual interest expense. Well, in order to put leverage on a business, you need a very strong business. You also need a very strong management. What do I mean by a strong business? Stable, recurring, or reoccurring revenue businesses, high barriers to entry, relatively recession-resistant, and not cyclical, since you can't afford big declines in earnings. ADT, the alarm company, which coincidentally I think Keith Meister is on the board of, comes to mind when I think of a recurring revenue business. They have millions of long-term subscribers paying monthly fees who don't typically leave during a recession. Second thing I think you need, second type of company, second characteristic of what would be attractive to a private equity firm is you need a company with substantial free cash flow. Accounting earnings won't do it. You need free cash flow. You do not want capital-intensive businesses that consume excessive amounts of cash. We ran a screen in the office, and we found close to 500 companies in the US and Canada with greater than a 500 million market cap that had accounting net income but that had no free cash flow. That does not work for a private equity firm. And lastly, you need a business that can grow its earnings to build equity value. These are the kind of businesses you can put leverage on and are therefore attractive to private equity firms. What do I mean by strong management teams? Well, they need to be very good at what they do. While that may seem obvious, it is often not the case, as you heard in the last panel. Many public companies have poor CEOs with friends on the board who won't fire them. You need a management that is accountable to owners of the business. If they don't succeed, they're out. Also often not the case with public companies. You need a management with an intense focus on the bottom line, very careful at managing the expense structure so as to ensure healthy profitability. And incredibly important, not just operationally good management, but a management that is financially astute and understanding of capital allocation. You often hear about private equity controlled companies that lever up to pay big dividends to their owners. Why is it so rare for public companies to ever do that? Well, we're looking for the few companies that do. I want to be clear about how important the capital allocation part of the equation is. There are many US public companies with excellent businesses, but very poor capital allocation. An example, Microsoft. Since 2007, from 2007 till year-end June 2013, 7-year period, Microsoft revenues went from $50 billion to $77 billion. Free cash flow went from $15 billion to $25 billion. Stock barely moved. I think the reason for that, and I'll get into it in more detail, is very poor capital allocation. Other companies, for example, DirecTV, the paid television business in the US and Latin America, they've grown somewhat more than Microsoft. The stock is up 155% since 2007. as the company is levered up to buy back huge amounts of its stock and has not done any really material acquisitions. Let's compare Microsoft to DirecTV. Microsoft, as I mentioned, revenue $51 billion to $77 billion, up 51% during the 7-year period ended June 13. Operating income up 37%, as the company has been investing in money-losing businesses like Bing. Earnings per share up 76% in 7 years. They did some share buybacks that helped drive the earnings per share. Free cash flow, as I mentioned, $15 billion to $25 billion. Microsoft had $33.5 billion of cash on its balance sheet 7 years ago. It today has $88 billion of cash and investments on its balance sheet. The company has done $22 billion worth of acquisitions and $9 billion of write-downs. So disastrous acquisition record. So sum it up, some dividends, some buybacks, clearly way too much cash on the balance sheet today, and a poor acquisition history. The stock was $23.50 on July 1, 2006. It's $38 now, and they've paid some dividends. But the stock has run up because, as mentioned on the previous panel, ValueAct, the activist firm, has gotten involved. If you look at the return prior to ValueAct's investment, prior to the disclosure of ValueAct's investment this past April, the return for holding Microsoft over 7 years, despite such increases in revenue and free cash flow as I've described, has only been 45%. Now let's take a look at DirecTV, the pay television business. Revenue, 7-year period, which will end 12/31/13, will have gone from $17 billion to the estimate of $31.6 billion, up 86%. Operating income up 104%, so they've kept a lid on expense growth. Earnings per share, this is extraordinary, has gone from $1.20 to what will be almost $5 per share this year, up over 300%. DirecTV, 7 years ago, was levered at 1/2 times debt to EBITDA, 0.5. Today, they're levered at 2.5 times debt to EBITDA, but they've really done no acquisitions. What DirecTV has done in the last 7 years is they've taken the cumulative free cash flow that they've generated, plus the additional leverage that they've taken on, going from 0.5 to 2.5 times, and they have repurchased 64% of their original shares outstanding. They've spent $29 billion, as I say, to buy 64% of their original shares outstanding at an average price of $32.40. The company will earn $5 this year. They bought back 2/3 of the company at 6 times earnings. That's extraordinary. So no dividends, no large acquisitions, just buybacks. DirecTV, beginning of 2007, was $25, $64 today, up over 155%. What's the lesson here? Both companies' earnings multiples have come down, likely reflecting their somewhat mature businesses and a perception of some technological risks. That being the case, DirecTV delivered far greater value. Why? I believe it's because it had a more shareholder-friendly capital allocation, and with an already levered balance sheet, there was not a fear of bad acquisitions. Buffett said it in his 1984 annual report, and I quote, "When companies with outstanding businesses and comfortable financial positions find their shares selling far below intrinsic value in the marketplace, no alternative action can benefit shareholders as surely as repurchases." So I've described what a private equity type of public company is. You need a great business and you need great capital allocation. Let me be clear, there are many such companies in the United States, but most are valued appropriately. Coca-Cola, for example, certainly would meet these parameters, but it's hard to make money buying a stock at close to 20 times earnings. In assembling a portfolio of these types of companies, I think you want to buy them at 10 to 12 times free cash flow, low double-digit multiple of free cash flow. They are hard to find, trust me. So when you do find them, buy a lot. Make it a big position, monitor the companies each quarter, and be patient. To summarize, a strong, stable business, plus strong management with great capital allocation skills, plus a value price equal, in my humble opinion, a great investment opportunity. As an aside, you hear more and more about activists these days, of course, the panel that we just had. What they are often doing is getting involved with good businesses, trading at low valuations because of poor capital allocation, an example being Microsoft. Many of the activists are successful because they bring good capital allocation to the table, ultimately resulting in a better valuation. Lastly, some places that I think everybody can look to find private equity type publicly traded companies. We run in the office what I call a share shrink screen, companies that have been large buyers of their own stock. Our latest screen showed 125 companies in the United States that have reduced their share count by at least 15% over the past 3 years. That's always an interesting screen to look at. Activist-influenced public companies. Microsoft is a great example now that ValueAct has negotiated a board seat. In the small cap space, Starboard is a prominent activist. I personally was active with 2 companies that were ultimately sold for very nice premiums. Third area I think you can look at, public companies that have large private equity shareholders. Often, after bringing companies public, a private equity firm will retain a meaningful stake. I love looking at companies like that when their stocks trade below the IPO price. Lastly, known shareholder-friendly managers like Buffett, guys like John Malone of the Liberty Companies. I'll just take 1 minute to discuss an idea an example of a company that I believe fits the criteria I've just described, happens to be the largest position in our fund, Iconics Brands Group, ICON on the NASDAQ. It's led by Neil Cole, brother of Kenneth Cole. The company owns over 30 brands, which it licenses to retailers and wholesalers. Iconics has no retail stores or distribution centers and carries no inventories. It simply collects the license fees for the use of its brands. Gross margins are 100%, free cash flow margins are 50%, capital expenditures are minimal. The company is excellent at marketing its brands, and those brands can be found at retailers including Walmart, Target, Kohl's, Costco, and Macy's, as well as retailers throughout the world. Management expects $430 million in revenue and $210 million in free cash flow in 2013. The company has bought back 30% of its stock in the last 2 years. Valuation today is about 10 times free cash flow. The company will continue buying brands. I think we could easily see $5 a share of free cash flow in 2015. Stock is today $38. Thank you for listening, and again, many thanks to Prime Quadrant for having me.
So Jeff briefly touched sort of on a point that I think is important. Benjamin Graham once said, investment is most intelligent when it is most business-like, which is in sync with part of what Jeff was saying, particularly early on. Now, Graham, for those of you who aren't familiar, is the dean of value investing. He was Warren Buffett's mentor early in his career. And he gave us many pearls of wisdom, and that one from his famous book, The Intelligent Investor, is probably my favorite. Now, this is probably relevant for a lot of you who happen to be business people. You could probably envision yourself in this scenario, but for those who aren't, just hypothetically, suppose that you were a business person considering taking a stake in a private company. Chances are that you'd have a few questions, a few criteria that would run through your head. You'd ask yourself, do I understand this business? Is the balance sheet sound? Am I partnering with the right people? In other words, with management that is aligned with me, that has skin in the game, that has a record of sound operation and capital allocation. And of course, am I getting an attractive price? Is this a bargain? And chances are you'd insist on all of these criteria being to your satisfaction in order to pull the trigger. You'd want the complete package. Yet investors in the stock market often compromise on one or more of these criteria. For instance, they'll overpay for a stock because they really like the business. That's just one example, but there are many. And I've found that it's rarely worth making exceptions, even if it seems like, oh, it's tempting, yeah, maybe the management's not that great, but X, Y, Z. It's rarely worth making those exceptions. Why not insist on the complete package before committing your hard-earned capital, the same as you would if you were investing in a private business? Another thing you'd surely ask yourself, what are the risks and what could go wrong? Rational, my fund has done fairly well. We've gained about 26% gross and 21% net per annum since inception. That compares to about 11% for the S&P 500. But what I'm actually probably more pleased with than that is that we've done it with less risk, in my opinion. For instance, we've only had 2 positions that we've ever exited at a loss in the fund's history, and we've averaged 25% cash, which means that we've avoided putting our money at risk when there was a dearth of compelling opportunities. And one of the reasons is because I'm always reminding myself of Buffett's 2 golden rules to investing. And for those, in case you're wondering, rule number 1 is don't lose money, and rule number 2 is never forget rule number 1. And I'd bet that as a business person, assessing the risks and limiting your downside it would probably be the most important part of the equation, and you wouldn't mind even potentially missing out on a good opportunity in order to avoid suffering an impairment of your capital. But again, in the public markets, we often take those risks. We'll invest in a stock that we didn't research for ourselves, say, or that may be overvalued or have too much debt on the balance sheet because, for example, it pays a nice dividend or it's a hot stock that keeps going up. And that's where things usually end up going wrong. So though it may seem obvious, I think we'd all be wise to heed this simple yet often difficult to apply advice and remember to approach investing from a psychological and behavioral perspective in the same business-like fashion as we do the rest of our business affairs. Incidentally, one other thing that as business people we always ask ourselves is, how can I get an edge over the competition, right? Or even better still, avoid competition altogether. Where can I find a situation where there are forced sellers or panic sellers who want to unload an asset or a business irrespective of price and fundamentals, and where I can therefore get a true bargain? Now, this is nothing earth-shattering. It's common sense that the more competition there is for an asset, the more people know of it and like it, the greater the demand, and the higher the price you'll have to pay. Whereas what an investor should always strive for, be it in the private or the public markets, is to buy assets cheaply. Yet in the stock market, people will gravitate towards things that are rising and have a positive sentiment, and to large caps that everyone knows about and that therefore attract the most competition. And for those of us who ask the same questions and maintain the same discipline with stocks as we do with private investments, and indeed with our own businesses, and who are independent-minded and invest based on our own conclusions rather than follow the crowd, this can be an opportunity to generate outsized returns and incur less risk in the process. Because rather than look for companies that are big and well-known, we can look for those that are small and underfollowed, that the average investor has never heard of, and where the valuation reflects that fact. And rather than buy what's popular, this is where we can take advantage of other investors' irrationality. This is where we can identify situations where other investors overpaid for that stock with the juicy dividend that I spoke of a moment ago, or took a risk on an over-leveraged company because it could turn out to be a home run, only to realize their mistake later on and dump the stock in disgust. So here are some examples of looking for opportunities in unconventional areas where you can capitalize on irrational selling or just generally have an edge over the competition. So here's one example. After I graduated with my BBA, my first job was for the largest independent equity research firm in Canada, and within a few months they made me the income trust sector analyst. And as I was scouring for bargains in the income trust universe, it quickly dawned on me that a lot of these firms, they really shouldn't have been income trusts. For those of you who remember income trusts, there was a time when they were the flavor of the day, and they were often just an exit strategy for a businessman or a private equity firm to get a valuation premium, or for management to juice the stock by converting it to an income trust. But a lot of times these were businesses, not necessarily bad businesses, but just businesses not suited to distributing all their cash flow. Now things would be, everything was well and good until one day some of these businesses hit a blip and had to cut, or God forbid, suspend their dividend, and then the stock would get cut in half like clockwork, sometimes more. And a lot of times, again, there was nothing fundamentally wrong with the business, and yet all these investors who had owned it for the yield suddenly wanted nothing to do with it. And that often created a very, very interesting dynamic. And I can give you it's been a good source of opportunities over the years. One example is a company called Hardwoods Distribution, which was, as the name suggests, a hardwood and plywood distributor, mostly to the U.S. home building industry. And they got hit very hard during the U.S. economic and housing downturn. They had to suspend their dividend, again, because just the results went down. It was a solid business, but just experiencing a cyclical low. And the stock, which had previously been in the mid or high single digits, went below $1. And we were able to buy it in 2009 at an average of about 70 cents. At that price, it was trading at about a third of its net working capital, which means it's cash receivables and inventory less all of its liabilities. So you could have literally liquidated this company and still made money. It also had $4 of working capital for every dollar of debt, and it was actually breaking even despite its industry being in close to an all-time low depression. And lo and behold, as gradually the housing market started to recover and things started to get a bit better, the results improved, the company ultimately reinstated a dividend, and its earnings went through the roof as the housing market rebounded, and the stock, which was went as low as 50 cents, is today close to $8. So that's one example, and there are many others. Another instance of one of these sort of unconventional special situations would be a debt recapitalization, a dilutive debt recapitalization. So sometimes a company has a stretched balance sheet. They have nothing, no other choice. Either they go bankrupt or they do some kind of recap. And if you're a bondholder and or if you're a shareholder and suddenly your share in the company has suddenly been diluted by, let's say, 90% or what have you, you want nothing to do with this company under any circumstances. And often that will cause just kind of indiscriminate selling. But what's interesting is that that very same event that is causing the selling is also getting rid of the problem, because it's eliminating the debt that led to the recap. It's often accompanied by management that was responsible for the missteps being shown the door. Although obviously the business, each share is less valuable once it's been diluted, the stock will go down 60, 70% and often remain attractive. And one example of that is the brick. The brick was actually also an income trust. It paid hugely excessive dividends and just had a bloated balance sheet for years. And when the recession came around, they nearly went bankrupt. They were then recapitalized by a group led by Fairfax Financial and their founder, Bill Comrie. They kicked out the management, they brought in a turnaround specialist who very quickly just did a complete revamp of the whole business. Gross margins went up 300%. They went to having the best same-store sales in their industry by far. And they went from having so much debt that they nearly went bankrupt to actually being in a net cash position. And in addition, it was no small fact that about 13 or 14 company insiders, including Fairfax and the CEO and the CFO, had all bought stock in the public market. Now, despite all these facts, the stock remained under the radar of most investors and just overlooked because of the stigma of its near-death experience. And we were able to buy into it at about 5 times free cash flow in late 2012, and within a year, Leon's had announced that they were taking over the company at $5.40, which was over double the price we had paid. One last example, it's not exactly a special situation, but something that I think often has not been given credit as a good source of opportunities, is when you find a great manager, a great jockey, an owner-operator that just has a paper trail of outstanding capital allocation and really knows how to run businesses. And those people are rare. And what's even more rare are those that maybe not everyone knows about. Because we all know when we see Warren Buffett buy a piece of a company, the stock will pop simply because of his involvement. But for those who are a bit less known, simply finding a great one and saying, you know, what else is this guy doing can be a terrific source of opportunity. So here's another example. In 2009, we invested in a stock called Paramount Resources. And Paramount was 50% owned by a guy called Clay Riddell, who is a legend in the oil and gas space. The stock had fallen from the 30s back in 2007 to as low as $6. Interesting thing is that Paramount, among other things, had acreage in the oil sands that was single-handedly worth more than the entire stock price based on the present value according to the company's reserve evaluator. So you can get this entire business for less than the value of one of its assets. And Riddell, the fellow I mentioned, as I studied him, I just said, wow, this guy is phenomenal. He's off the charts. For example, they bought into the oil sands in 2001 before anyone had even heard the word oil sands. And then in 2007, they sold a portion of their acreage for $1 billion, an $800 million gain in 2007, and used that to completely deleverage the balance sheet and buy back stock at a time when it was highly depressed due to weak gas prices. I saw that and I said, well, what else is this fellow involved with? It turns out that he had personally spent $60 million buying 15% of all the shares outstanding of another company called Nualta, which was an oil field waste management company where he'd been a director for 20 years. I looked at Nualta, and here was another extremely cheap stock, low single-digit free cash flow multiple, 20+% ROEs, and it had come down from over $25 to $3. We bought that as well, and ultimately both ended up being triples. So that's another example. If you find a great jockey, just ask what else they're involved with, and you'd be surprised how few people really do that. And just one last example, a current stock we own that fits the bill would be a company called Supremex. It's an envelope manufacturer. It has about 60% of the Canadian envelope market. Here's another former income trust that's reduced its dividend by 90%. The stock, which had been before the downturn about $6 or more, went down as low as $1. But the stock, a new investor came in, cleaned up the company. They've paid down 60% of the debt. And although it's a declining business, today it trades at just 4 times free cash flow and yields 8% despite having a payout ratio of only 30%. And it has a very strong catalyst because that same new shareholder has raised dividends at 3 other investee companies in the last year, and the average one has experienced a gain of about 40%, and I expect more for Supremex as well. You can easily raise the dividend 50% or more from here, which I think would result in very nice upside. And I'd be happy to elaborate if anyone has any questions. Thank you.
And now our last speaker, Frank Martin.
Kind of pleasant to be around a couple of sharp young guys like this as the senior member of the panel. Davey told me I had 15 minutes to talk. That's my job. Your job is to listen for the same amount of time. If you happen to finish before I do, please raise your hand. Let me begin by saying that most of my professional life, I've been a long-term value investor. In the 1980s, as many of us in this room know, most of us had more ideas than we had money. However, since the peak in speculative contagion in 2000, I've been increasingly leery of investors' acceptance of ever-expanding dangerous systemic risks as the new normal. Let me explain why. The mother of all harmful investment mistakes is mistaking the absence of evidence for the evidence of absence. In other words, assuming that just because historically infrequent and potentially catastrophic events known as black swans haven't occurred, that they won't. Metaphorically, a turkey is fed for months by a farmer. Every day the turkey confirms with increased statistical confidence that the farmer loves him. The farmer keeps feeding the turkey until a few days before Thanksgiving. So when confronted by the farmer wielding a meat cleaver, thanks, Mo. Wielding a meat cleaver, the turkey has a revision in belief, a rude awakening right when its confidence in the farmer's love is maximal, life is good, and everything seems predictable. But then, of course, it's too late. Investors today are in love with the farmer who fattens their portfolio of risk assets with easy money. While I'm sure many wonder about this apparent exception to the free lunch rule, the food is so delicious and the conversation so affirming that few can back away from the table. With history as our guide, the bill for the free lunch will someday come due. They always do. To the extent that an unexpected future rude awakening results in lower prices for risk assets, I'm also worried that most investors have been conditioned to expect that it will follow the turkey wishbone shape of late '08, early '09. You know, like the fellow who has forever eaten more than he should and exercised less than he should and takes a few days off for quadruple bypass surgery, and then he's back at the old game again. If the future event is expected to actually change behaviors, I doubt that we will get off that easy. Even after 2 costly free lunch episodes in the last 13 years, upon which my firm capitalized, I fear the underlying causes, deeply rooted in human nature, were deemed simply too unsettling to address forthrightly at the time. They are tomorrow's problem, and they are accumulating. With a little help from an obscure Frenchman, years ago I discovered an investment success is more likely to come from those who have some clue about the counterintuitive way the thought processes and subsequent behaviors of crowds differ from individuals in isolation. Individuals who submit to the will of the crowd are effectively hypnotized. Their behaviors become emotional, impulsive, and very difficult to terminate. Gustave Le Bon, a student of the French Revolution, whose work I discovered in a rare bookstore many years ago, wrote The Crowd, the Study of the Popular Mind, just before the turn of the 20th century. His logic was so shockingly simple to understand and to apply that some of the most heinous mass crimes of the last century were perpetrated by men who used Le Bon's logic to manipulate crowds. For those whose interest in understanding crowds is more inclined towards self-preservation, Le Bon leads us to believe that individuals who are independent but of adequately high intelligence may in fact be functionally smarter than a crowd of geniuses. Crowds elevate their heroes and role models to disproportionate heights, and the powers of persuasions for those iconic figures are most acute when their suggestions appear simple, irrespective of their connection to reality. The crowd, as Le Bon would have predicted, gravitated to Alan Greenspan's beguilingly simple suggestion during the Great Moderation, a policy that became known as the Greenspan put. As has become apparent in 2013, it has been nearly impossible to terminate. Investors' confidence in the Fed's love is maximal, life is good, and everything seems predictable. Just like the mood of the Thanksgiving turkeys as the day of truth draws near. Those who move prices are part of an amorphous, synthetic, and increasingly global crowd like never before in history. due in part to the explosion of electronic media with connectivity so instantaneous that there's no time to think. And so the crowd knows the price of everything and the value of nothing. The market's message is particularly insidious today because it lacks the tympanic rumble of a typical bubble. It's a herd of the needy, not the greedy. The effect is the same, but without the telltale clamor. Fortunately for me, investing is not rocket science. Temperament and understanding predictably irrational human nature is likely more important than raw intelligence. It's a great relief to know that I don't have to be a Stephen Hawking to rise above the tyranny of the crowd, that the lone wolf can accomplish the unexpected if he keeps his wits and understands his adversary. There is one conspicuous flaw in the crowd's susceptibility to suggestion that fiercely independent investors can exploit. Greenspan reveals the irony, if not the fatal conceit, of economic forecasters in his just-released book, The Map and the Territory, Risk, Human Nature, and the Future of Forecasting. He says, and I emphasize, even repeated forecasting failure will not deter the unachievable pursuit of prescience because our nature demands it. Undeterred by the facts and acquiescing to the presumed supremacy of human nature, people continue to listen to forecasters. It may be human nature, but it's not mine. Value investors are not market forecasters. They don't predict prices. As Guy was clear to point out, they react to prices set by others. Accordingly, Seth Klarman cautions that the success of an investment firm is not solely dependent on its quality of its work. The collective behavior of the entire investment community determines market prices, and price fluctuations in turn drive investment opportunity. We all know this. When buyers are numerous and sellers are scarce, opportunity is bound to be limited. But when sellers are plentiful and highly motivated and potential buyers are reluctant, great opportunities tend to surface. All of this brings us to Nassim Taleb's notion of being anti-fragile as a way to avoid becoming the Thanksgiving turkey and even profit without relying on forecasts. Fragile systems break when exposed to random shocks. On the other hand, anti-fragile systems are not merely robust, they actually get stronger when exposed to unpredictable stresses or mistakes. One need not forecast to protect oneself from random risks. One need only apply a simple test of asymmetry to decision making. Anything that has more upside than downside from random events is anti-fragile. The opposite is fragile. Think of the body's immune system. It gradually becomes anti-fragile only if exposed to outside bacteria. The price of temporary physical discomfort is the buildup of antibodies in our immune systems. The capital markets have evolved over the millennia as natural complex systems. Each generation of investors has historically been exposed to periodic random stresses that has kept it relatively anti-fragile. The occasional setbacks and shocks have made them stronger and more resilient in much the same way as the human body's immune system. Not only did the capital markets survive the panic of 1907, the crash of 1929, but perhaps or rather in spite of the devastation, investors developed antibodies to ward off speculative contagion, otherwise known as an acute aversion to risk. At great sacrifice, generations of investors became less fragile because they were hardened in the crucible of adversity, thus strengthened. They won by not losing in the face of much misfortune for decades to come. That is, until the great moderation in the 80s and the 90s. Interventions in the natural order of things have compromised the market's natural immune system. In tampering with this delicate pricing mechanism, our one-sided monetary policy regime truncates market declines, but foments runaway bubbles on the other end, and the economy seems increasingly resistant to an ever-growing ratio of debt per dollar of GDP. In the name of short-term pain avoidance, by those who have no skin in the game, monetary policy, antibiotics have been overprescribed. The once fragile system is becoming more and more susceptible to comparatively benign shocks and the consequences that could be catastrophic. 3 weeks ago, the U.S. Centers for Disease Control declared that we have entered the post-antibiotic era. After decades of overprescribed antibiotics, some bacteria have become resistant. Moving from the conceptual to the real, I spend the bulk of my day reading the work of others whom I respect. Besides Dave Rosenberg, there are other estimable Canadians. A former Torontonian who now lives in Basel, Switzerland, Bill White served as chief economist for the Leading Edge Bank for International Settlements from 1994 to 2008. His credibility was really established at Jackson Hole in 2003 when he and Claudio Borio warned Greenspan of the dangers of perpetual easy money. Their recommendations fell on deaf ears. As recently as 2 months ago, White said the 5 years since Lehman collapse have been largely wasted, leaving a financial system that is even more fragile and perhaps running out of remedies and lifelines. The world, he observes, has become addicted to easy money, with rates falling ever lower each cycle, which leaves very little ammunition if the system buckles again. He went on to say all the previous imbalances are there. Total public and private debt levels are 30% higher as a share of GDP in the advanced countries of the world than they were in 2006. Leveraged loans to junk-rated companies in the U.S. will reach a record $1 trillion in 2013 compared to $160 billion in 2009. As for the unwitting individual investor, Bill White observed that the hunt for yield in a zero-bound interest rate environment is luring crowds into investments with higher risks than they realize. He describes it as a phenomenon reminiscent of the exuberance prior to the global financial crisis. During periods such as the present, portfolios can be protected by holding anti-fragile assets. Cash is foremost among them. Now, before you roll me literally out of this room in a straitjacket, let me justify my insanity. For the longest time in modern history, cash pays nothing. In fact, adjusted for inflation, the return obviously is negative. Illogical as it may seem, the best time to own cash is when no one else wants it. Why is that? Because the crowd is scrambling to put their money in something, anything that does pay a return, and that leaves the scales unbalanced. Interest rates are so low, eventually they have nowhere to go but up. I think that's been the recurring theme all day. And when that occurs, the prices of stocks and bonds will go down. As Warren Buffett has observed, cash is much more than an asset that currently yields zero. It is a call option on any asset with no expiration date and no strike price. For the more opportunistic, one can position oneself to profit from the unpredictable of events that have catastrophic effects on fragile assets. Michael Lewis brought Dr. Michael Burry out of obscurity in the best-selling book, The Big Short: Inside the Doomsday Machine. Interestingly, Burry caught the eyes of his hedge fund sponsors with adroit stock selection earlier in the decade. But the trade that put Burry on the map was buying CDSs on toxic pools of securitized mortgages he didn't even own. In our parlance, he went long the short side. While Burry saw extreme fragility in the securitized mortgage pools, the same vulnerability was apparent to me among the once prominent investment banks on which I purchased more mundane put options, first in the summer of 2007. Both of us realized the potentially huge asymmetric payoff while exposing most of our capital to minimum risk of permanent loss. Because we opposed the crowd sentiment, it was not a happy time for either of us. In short, and a bit cliche, it's easier to fish a stock pond than it is to find needles in haystacks. In true value investing style, it's all about stacking the odds in your favor by understanding Mr. Market, aka the crowd, and patiently waiting for him to make you a deal that you simply can't refuse. I have no doubt that one of these days I will again have more ideas than money. Between now and then, Mr. Market, seemingly indifferent to risk, may provide non-conventional ways to enhance wealth without putting one's portfolio squarely in the path of market risk. Thank you.
Thank you, gentlemen. We have a few minutes for questions. If you would put your hand up, somebody will bring you a microphone. And maybe following on Frank's comment about cash, investors often feel that cash is burning a hole in their pocket. What advice would you give to investors to help them overcome the need to always be fully invested? Perhaps I can start with you, Frank, and then get Guy and Jeff to weigh in as well.
Buffett's view of cash as an option is so important because nominally, if you look at cash today, it pays nothing. But in fact, it is that option on the future, on any asset, without a strike price and without an expiration date. And that's huge, particularly if you believe Seth Klarman's view that tomorrow's opportunity set may be dramatically different from today's. And we only need to go back when I was writing about the perfect storm in 06 and 07 and realizing that maybe things weren't going to continue on as they had indefinitely. And then the world changes in 08 and 09, and all of a sudden the optionality of cash proves its worth. So when it's least attractive, it's probably most attractive.
I look at cash in two ways, and it's pretty common sense. First of all, it's better to earn nothing in cash than to lose your money on a bad investment. So simple. You have to hold on to your standards. Don't buy something just because you have a lot of cash to put to work. Ask yourself, apply the same standards that, again, you would with your own business or with a private investment opportunity to the stock market, and it's very simple. If it's a bargain, if it's compelling, you can buy it. If not, why would you risk losing money just because you happen to have cash? So that's number one. And number two, what's always helped me, and this is something that I learned from Bruce Berkowitz at Fairholme, which is where I worked prior to starting my fund, is cash is a weapon. Think of cash as a weapon. Cash is what allows you to take advantage of incredible bargains, of rare opportunities that are only around precisely when nobody else has it or when everybody's afraid to use it. And the great fortunes over time, over history, have been made by people who had the cash and had the conviction to put it to work exactly at those times when no one else did. But you never know when those times will come. So think of cash, A, as a better alternative to losing money, and B, as a weapon to be used during times of distress.
I couldn't agree more. We operate our fund typically with very healthy cash balances. In 2008, there were companies trading below cash per share. If you had money around, you can buy them. If you didn't, you couldn't. And in general, the way we operate is we buy cheap stocks. If we find them, then we buy them. If we can't, we're in cash. So cash is a default, but always good to have cash around for times like 08.
I have another question for you. All three of you invest your funds in concentrated portfolios. Why is this, and how many positions do you think are too many?
I think all the graduate students in the room with MBAs know that somewhere between 12 and 15 names reduces random risk about as far as you can practically reduce it. So there's a lot of mathematical back testing to show that that's a reasonable way to avoid random risk. And by avoiding random risk, you can possibly avoid market risk by being in companies that may be uncorrelated. I think the other argument is if you feel you're safe enough with 12 to 15 names, adding simply another for more diversification, a name that might not equal in quality to the others, strikes me as an absurd decision.
Warren Buffett once said that the best way to reduce risk is to think. And how can you think about every investment when you have 100 of them? You can't. And so I would say there are two ways to approach risk reduction. One is to say, well, I'm going to own 50 different things, and yeah, maybe I don't have a tremendous amount of conviction about any single one of them. Maybe I haven't done 100% of the work, but, well, they look all right. But if you truly want to, again, have that discipline we've been focused about, we've been discussing, and only hold the very most compelling bargains where you just have that feeling that it's so incredibly cheap, so undervalued, that, unless the world blows up, you just can't imagine a way you could possibly lose money, and chances are you'll make a bundle of money. But to get to that point, to build that conviction, it takes so much work and thought, research, that you simply can't do that with a very large portfolio. So it simply makes sense, if you want to find those very best ideas and build that conviction in them, to have a concentrated portfolio. There just aren't that many bargains out there.
Agree completely. There's no reason to own the 26th favorite idea you have. You might as well just own the 10 to 12 that you think are great.
Terrific. Jeff, Guy, Frank, thank you so much for joining us today and for your insightful comments. Before we take a quick break, I'm just going to invite